All right, good morning, everybody. Slow start to a new week. Mixed bag. Got Hong Kong down more than 0.75%. Japan down 0.5%. U.S. markets in various degrees of down, but the Russell is in the green, 0.25%. It's not enough yet to hit our benchmark 0.5%. But it gets us back to looking at the first of the year and kind of a little hint at a short squeeze. We'll see if it, catches on with the move that we saw back in January, February. Factory orders is the biggest thing on the list today, but for the week, it's all going to be jobs. And we're going to get different job numbers through the week. It's not just unemployment. But the biggest one will be on Friday. This is really the Fed's way of gauging how well they're accomplishing their goal. So today, mostly it's going to be various Fed speaks, European Central Bank, a little bit out of Tokyo, out of Japan tonight. And the biggest focus is on the 10-year and the dollar. Some spot gamma levels. You want to grab it in a screenshot. $10, $11.30, $12.30, and that's a wrap for us, other than all those Fed speaks. So we're looking at normalized volume today. Nothing really standing out. 100, it's not too heavy, it's not too light. It's exactly where we would want it to be. So just get it out of the way. There's no market maker move, so we know they're not hedging in the front end. This is a weekly chart. We still got our proximal and our distal lines from that rally base drop. %50 of last week, 45.76. That's the halfback. So we can see weakness this week. We can even dip down below that line, but we need to close above it at the end of the week. If we're going to maintain this bullish posture, then that's kind of our line in the sand at the moment. A little bit of weakness makes sense after the kind of move that we've seen to get to where we're at. We're in the final stretch for the year, and the consensus seems to be that we're not really going to see too much performance chasing, because you were either in the move and you've already did capture the meat of the move for the year, or you got left in the dust and there's no amount of work at this point that could get you caught back up. I don't know if I necessarily agree with that argument. I think that a lot of fund managers that I've heard on Bloomberg who didn't participate in this run and or were even short through this run up off of the lows through most of the year, they're going to have to have something to tell their clients. So I don't think dismissing a performance rally at the end of the year makes sense. Not yet. I want to see a little bit more. It just seems a little too off the cuff. So we'll see. Either way, we got our halfback level for the week. We've got a reasonably decent setup too. You know, if we're looking for a continuation to the upside to get us into that proximal zone. I would rather, you know, go long from a pullback than go long from the highs. It just makes sense, right? The argument though is in a trend play, you want to buy low, sell high, and a pullback is perfect. In a momentum play, you buy high, sell higher, and a pullback is the end of that momentum run. So last week, we had that really good dip to the start of the week. We cut through 50% of the previous level and then rallied back out of it. So if we're looking at last week for a consideration of what we could get this week, we've got the same sort of setup. The difference though, last week, 45.50 was the halfback level, and that's a significant major level. This week, 45.76, it's not so significant. So we'll keep our eye on it. It's the level of concern, but it just doesn't have the same weight to it. $45.85 is the halfback level from Friday. So we can dip down below that level, make contact with it, whatever. We need to get back above it and close above it by the end of the day. So a little bit closer on our benchmark. We do have an angled trend line. We weren't able to keep the breakthrough, and so far we're just kind of digesting that level. It's not yet a rejection because this candle isn't closed, but it's looking like a rejection. These blue lines here are the 10-period moving average. We got a reset Thursday into Friday, so a nice springboard for a continuation. If we do cut through 45.76, then the idea would be that we get tangled up into that 10-week and we hold above 45.50. It's kind of a must-have at this point. We're still under the call wall, which means we can go to the upside, but we'll sort of top out at Friday's high. That call wall, unless we see it getting rolled today to the upside, is going to be resistance. It's just a wall of sellers at this point. And until we see something different, that's how we have to approach it. So getting an inside day breakout, testing against Friday's highs, is very likely going to be a first touch rejection play. And we might be able to grind our way through there, especially if some data comes out or one of these Fed speakers, you know, continues to pump the idea that they're going to cut next year sooner rather than later. We're tangled up in our pivot points. Generally speaking, when we're above the weekly, we're bullish. When we're below the weekly, we're bearish. When we're interacting with the weekly, then we've got a market, you know, in chop, basically. So it needs to resolve this. 4607 or 4600 is a major level to get through. So we're going to need something significant to get us through that level. There is a voodoo line up there, by the way, 4602. So we got the roundy 4600 and a voodoo line and the previous week's high and the call wall. You got to consider that's just significant resistance. This is the SPY. Just wanted to point out something. We're on a quarterly chart, and this big candle from last year, we can apply fib levels to that just like we do any other big candle. $457.83, and the halfway point, what I call the warning center, if we do get that breakout, the 111, is 468.5. Call it, 468.50. That's the upside target for this breakout. The outcome, the final target before we pause, would be 480. So if the breakout is fake, we're likely going to stall and fall back at 468.5. If it's not fake, we'll get to 480.5, and then we'll stop and pause. Ten-day, 30-minute volume profile. It's still relatively tight. We don't have much of a signal here, unless we just want to consider a classic D. But these volume along the low, that Friday and a little bit of Monday, we're going to drop that off today. That'll tighten us back up between 45.40 and 46.10. That's a really tight range. So one of the reasons we pay attention to really tight ranges is it's where we start to build energy. And that can be a little misleading because volatility will oftentimes stay low because volatility is a reading of movement and we're not really moving anywhere. But make no mistake about it, the longer we stay in a tight range like this, the more energy we build up, so that when the move does finally come, it's usually ferocious, fantastic. Consider it a bit of an air pocket of risk if we do break 45.50, but that's a long ways off. We hit a long time VPOC Friday, and on the first touch, it was fantastic. So just kind of back up to that first touch. 46.03, beautiful rejection. Of course, we did finally work our way through there, but that one's now off the board. It's been on the table for a long time. We don't have one to carry forward from Friday because we've already cut through that level multiple times in the first few minutes last night. So no VPOC here. And on Friday, we were talking about the size of the new week. but the box hadn't been set in stone yet. The week wasn't over. So we just do the same thing again on Monday. Measure the box. Don't need to get all nerded out and specific with it. Just close is close enough. Measure the old range, set it on the new range, and ask a basic question. Is the range this week bigger or smaller than the range last week? If it's smaller, then there's less volatility priced in. If it's bigger, then there's more volatility priced in. And as we can see, the box that I drew extends outside of the new week. So this week is smaller in range than the last week, implying that there's less volatility priced in. That makes sense because we just talked about we're in a range. When we're in a range, volatility tends to drop off. This is after Friday's close, the second week back to back that we actually stayed inside the range, which is a nice change of pace since we had been breaking out of and closing out of the range consistently for the past couple of weeks. It's supposed to be an 80% success on S&P. So that could be SPX, SPY, ES, XSP. They're all the S&P. The S&P statistically is your most accurate expected move model. And it's supposed to close in this box 8 out of 10 weeks, 80% of the time. The numbers say it only is supposed to do it, 68 point blah, 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 but it has a history of 80%, so I hold it to that standard. Even when I cut it some slack and say 7 out of 10, okay. I mean, that's what we would expect out of anything else, because that's what the model is, one standard deviation, 70%. This thing has been consistently breaking and closing outside of the expected move more than 50% of the time. That's so inaccurate, you can do better flipping a coin in the air. Very often when we get a tight range, we will get a fake break in one direction before getting the real break in the other direction. It's often called draw and raid. They draw in the trader and then they raid the liquidity before dumping in the other direction. This isn't clean enough to be a raid and draw, but that is a very tight range. And so the argument right now is this breakout a part of a fake breakout before heading to the downside, or is it truly a real breakout? Now, we don't really need to guess. We can wait for it to Busby somewhere around that 45.80 area, retake the high, and continue up into 46.50 before we start flirting with 4700. Or we break back inside of 45.80, break outside the bottom of the weekly expected move, and test these buyers down here for remorse. So we don't have to guess, just let it give us a directional play and we take it from there. For that Busby, just keep in mind, price can wick down back inside this box as long as it doesn't close inside that box. And it's a pretty sloppy box. There's nothing to it. I just kind of slapped it on there. You would definitely want to use, quant levels or something, right? Candle of control. $45.80. We're a little more than 0.5% above the 10-day moving average. And we're kind of chopping around that low. The wave is certainly not going to be a smooth shot. We did get our decline back for the reset. Now we need to digest this reset and either move back up and or cross through. When I look back and try to find examples of this kind of a move, there's not a lot back there to really lean on because it was just such a fantastic move to the downside, or I guess first the move up, but there's not enough here yet. One thing that we can say looking at this though is that even with that good move that we had last week, we're not overbought. It doesn't owe us a pullback. We didn't travel too far too fast. We're still 2.5% above the 10-week moving average, and we are on the decline after getting above 3%. This doesn't look bearish by any stretch of the imagination. And we're not overbought, and in fact, we're off those highs. So we've already started easing back. This fade back, by the way, as it implies a wave, doesn't necessarily mean it has to come in a straight shot. We've seen where we've faded back before and still took a run up before fading back again, long before we ever got back down to the zero. So zero is not really the destination. It's more of an idea. Are we heading towards that moving average, or are we heading away from that moving average? The China ADRs are down 1.5%. So BABA, for an example, has a market maker move, pretty significant gap down. It is still holding inside of Friday's range, but it's a reflection of a lot of these other ones. Here's Baidu, same setup. PDD is already trying to reclaim that drop down. And JD just really not getting any flows yet. Tight range, really tight range down there. So those are the China ADRs I tend to focus on when we see KWEB down, or even emerging markets, which isn't down as bad, but is still down. Nat gas is another one. The monsters of tech as well, down 0.5%. So they've kind of been doing their own thing lately. Take a look at Google, down, testing Friday's low. Microsoft, same. Apple, same. And they all have market maker moves showing a lot of hedging in the front end. Meta, same. Not Netflix though. Netflix broke Friday's low and now is struggling just to get back inside of Friday's range. So a little weaker than the others. AMD closer to Friday's high than Friday's low. a lot stronger than all of the others that were looked at. And if you're thinking, why is he looking at AMD? It's one of the NY FANGs. So if you go to the NY FANG index, AMD and Snow are on that list now. When Twitter left, right? They did some rebalancing, and AMD and Snow, I believe, were added at that time. I'm not quite sure when Snow was added, though, to be fair. I don't know if it was then or I don't know. But either way, Snow is on there too. And it also is more mid-range from Friday than at the lows or breaking those lows. NVIDIA, for an example, looks a lot like Apple and Microsoft and all of those guys, closer to Friday's low than the middle or the high. And Tesla, closer to the high rather than the middle or the low, kind of doing its own thing. So we can lump all of these in the same basket, and treat them like the FANG names or the Magnificent Seven or whatever. But really, it seems like we've got two classes of groups right now. You've got your Google, Microsoft, Apple, Meta in one side, and then you've got things like Snow, AMD, NVIDIA, Tesla on the other side. It's a weird breakup. Bitcoin is up almost 8%. And in my Bitcoin or crypto proxy list, semiconductors do fit in that category. So this is a little bit of like a mixed bag. So here's my crypto list, and NVIDIA is on there, Taiwan Semiconductors, AMD. So they might be in the same basket or the same bag, but they're not getting any of the love. However, things like Mara, Riot, Coin, MSTR, those are all getting that gap up this morning, and they look like fantastic shorts. I don't know. I just I keep looking at that gap up this morning in all of those proxy names, thinking this might just be a nice trading opportunity. So Riot, for an example, $2.20 on an 11-day move. Add the market maker move, and that gets us $3. This morning we're sitting at 15.30, 15.50. So here's at the money. The options have already, the options chain has already adjusted, but these prices aren't real. Never trust these prices in the pre-market. But if we're looking for a $3 move, say we focus on, 13.5 or 12.5, we're looking at what, 45 cents for an out of the money put 2 weeks out. Now, of course, you could turn it into a spread. It's 50-cent strikes. So, that would be a real cheap put debit spread, 15 cents. But those are pretty cheap puts anyways. Reasonably tight on the bid-ask spread, especially for closed prices, right? Once we open up, these ought to tighten up a little bit. Same thing with Mara, $3 move gets us from 15 down to 12, about $35 for a put. Got a $20 move on coin for the 2-week time period. That gets us down around 25. Looking at about $1.33 as a put debit. I ran call credits on coin last week and the week before, and I was able to close them in a day or two. It was this pullback. So I guess it wasn't 2 weeks ago, it was just last week. That thing monetized crazy fast. The options just getting the life sucked out of them. Either way, we got this fantastic cup. No handle yet. Big breakout. And what you do with a cup like this is just measure the whole thing. You can see how we're coming into that 130, call it 137. That's the 50% mark of this range. I know it's a sloppy chart. It's this range. So likely to digest there a little bit before continuing on. So, if you're not necessarily thinking about a short as an actual directional play, then a call credit spread, not bullish, is not the same as bearish. And really, I'm talking shorts here, but Riot, Mara, Coin, they're not falling yet. So, we still need some signal for the short to even begin. Now you might want to focus on, say, the half back of this range, and or just breaking that low, breaking 141. If you're more aggressive, then you'll be looking for a rejection around that high, some signal that it's going to fail to make it through there. Monday gap ups, to me, are more bearish than Monday gap down. So, when I'm looking at all these cryptos that are gapped up, I'm seeing a bearish bias. The thing is, when you do get a gapped up Monday or a gap week and it holds, it's a really bullish signal when it holds. So for an example, back here, when we had this move to the downside, and then we had that gap up, and look at the follow through on that gap up, right? So we closed here for the week. We opened gapped the next week. We really didn't try to close that gap, and then we just ran and continued to break levels all the way up. It's a fantastic recovery, right? So, and then there was another one and another one. There was all kinds of bullish gaps up in that whole move. So a bullish gap up that holds is really bullish. Generally, though, when we see a gap up on Monday, I am more bearish about it than bullish. So let it play out a little bit. Low risk entry is cheapest across the top. Your risk is smallest across the high. If you want to wait for confirmation, once we fail that high, break 50%, you could trigger there, and or once we break the low. The good thing is if you're going to try to short any of those, they should all be failing. So, if you're shorting coin, watch Mara and Riot. If you're shorting Riot, watch Mara and coin. Kind of get the idea. Don't trade and watch the one single chart that you're trading, because, well, that's kind of worthless. Solar's up a little bit this morning too. Airlines, uranium, Bitcoin, solar. That's a mixed bag of goods. Now there was MMA and deals going on, airline news this morning. That might have some little bit to do with it. But transports last week were getting some flows anyways. Kind of makes sense that we're looking in that direction. Uranium's just been a monster all year. And a lot of those refiners were, if we want to start getting into energy talk, those refiners were expected to be offline through November. So we, of course, seen pullbacks through November. But, November's done. And they don't stay shut down for service forever. So it makes sense we're going to start seeing uranium come back to the table. I don't know what's up with TAN. I haven't had a chance to dig around this morning, see if there's some news on solar. And then small caps, the Russell. Yeah, they're not getting any flows this morning. Nah. So Southwest is up. Is up the most if we just leave the ETF jets out of it. This is a really nice reversal off of these lows, but it's got a lot of work to do. It's not like the comeback kid, for airlines. They're poorly run companies. They have a history of mismanaging their funds. Lump them in with cruise line companies. And that's starting to look a little untenable anyways in that shape of that reversal. The halfback is at 30.72. So there is room to the upside before we get to that halfback. Otherwise, if we were just using like normal fibs, then the 786 would be the level I would watch for being able to answer that question after this significant move to the downside. Is this just a pullback before rolling over and continuing to go to the downside? If we're answering that question, the pullback has pulled back farther than it should have for a 786. The textbooks say, 618, but I'm just not a fan of using 618. If it makes it through 786, which it has, we're past that point, then the next level to focus on is the halfback level. That's 30.72. So now we just got to focus on letting that play out. On the weekly, if we did measure this base down here, kind of focus on, a 50% breakout. $26.54 is the halfback of that measurement, and that needs to hold. So that's kind of the line in the sand. Love's got the same chart, just, a little bit different, but the same idea. And then it's up, more than 1%. And then Delta, a bit more stretched, a bit more like Southwest. Whoa. Just remember, gapped up markets on a Monday, I tend to focus on those looking for a reason to short them. Uranium also turning around during the briefing here. We'll see. We might not get a chance. We might just turn it all around before we even get there. All right, the 10 years under its VWAP. We're still more on the high side of Friday than we are towards the low side of Friday. So 50% for bonds. Let's just keep that halfback level, 117.5. For the Dixie, it's the same thing. We're underneath, or yeah, we're underneath. Not by much, but we're there. So we don't want to see the Dixie rise. It needs to stay underneath that halfback level. We can see it tested 103.5. That's a major level. It tested it and it didn't make it through, but it didn't dump. So it's still going to come back up and try it again. We see the Dixie above 103.5. We'll focus on an inside day breakout, getting back up to this 103.71. If we get an expansion in the Dixie, we really got to keep our eye on what the 10-year is doing. See if we're going to get that follow through here. We're above VWAP, so it's already through the worst. $4.28 is going to be the level for the 10-year. And really, it's going to come down to these two names, the 10-year and the Dixie. So we want to see them hold below that 50% mark. We don't really want to see big moves, just kind of keeping the levels, not really expanding that much. When these get into resistance, we want to try tying that in with the S&P and the NASDAQ getting into a support level. That way we can, run the correlation. If they resist and fade back, then we'll be looking for the S&P and the NASDAQ to find support and run up. We're not at those levels though, so it's kind of the thing to watch. The other thing worth watching, not just today, but on the week, is any sort of risk parity. So, bonds, for an example, are under their VWAP, but they're holding in the upper part of Friday. Yeah, I guess they're holding about as well as the ES, right? Kind of look at it from that point of view. So with risk parity, we would be looking for an inverse bond, right? Bonds testing the high of Friday while the stocks, ES, testing the lows of Friday. Right now, they're not perfectly in sync, but they're both under VWAP. They're both about mid Friday's range. We'll keep our eye on those for that inverse relationship to show up. It's a pretty simple day today, all things considered. Watch the clock, guys. Be careful, be safe. I'll see you all tomorrow.